All right, we're going to talk about Chapter 11 now, and this chapter has to do with accounting for equity. Equity is the amount that the owners have put into the company. When we talk about equity, we're talking about it from the standpoint of a corporation. And a corporation, people form corporations for various reasons. One of the most important reasons is because if you have a corporation, then there is limited liability of the stockholders. Stockholders are not liable for any corporate acts or corporate debt. So if somebody, if the corporation does go into debt, a creditor cannot come after your personal assets. They can only come after the assets of the corporation. So that's one of the key reasons why people choose to form corporations, because it protects their personal assets from the corporate assets. The major disadvantages of being a corporation is that you're subject to a lot of government regulation, and you also can be subject to corporate taxation. Not all corporations can be taxed, have income tax on their corporation income, but this class is not the class to get into the differences between corporations. But again, one of the reasons why somebody might choose not to incorporate is because they're trying to avoid income tax as a corporation. In terms of a corporation itself, the corporation is owned by the stockholders, but it's not necessarily run by the stockholders. The management of a corporation is left up to the board of directors, and the board of directors often assigns a president, vice president, various officers to actually run the company. So just because you own some stock in a company doesn't mean that you have the right to manage the company. That's done through the board of directors. When you start a corporation, there are often organization expenses in getting the corporation started, and those expenses are expensed at the beginning of the development of that corporation. They're not something that are capitalized, that are spread out over the life of the corporation. So just keep that in mind, because you may encounter this in the homework problems. All right, I'm going to let you read the rest of that. But let's look at this part here. In terms of the stockholders, as a stockholder, you have various rights in the company. And one of the main things that as a common stockholder that you have is the right to vote. And you get to choose the board of directors. You also can obviously sell your stock. If the company decides to issue more stock, you have the first opportunity to buy stock based on your own percentage of stock that you own at that time. You also have the right to receive dividends if a dividend is declared. And then if the company does have to be liquidated, you have the right to share in any assets remaining after all creditors and preferred stockholders are paid. So these are some of your rights as a stockholder. You also have the right to receive any financial reports that are put out so you can keep up with how the stock is doing. It used to be that when you bought stock, you always got a piece of paper that was your stock certificate. And that was a very important piece of paper because it really was your proof of ownership in that company. In this day and age, with everything being electronic, we rarely actually print these stock certificates to people. Everything's just kind of kept in electronic records, but there are some companies that still do this. And obviously most of us are aware of stock that's sold on the New York Stock Exchange or some of the other exchanges that exist, and generally speaking most stock is handled by brokerages and banks and things like that. You don't individually buy or sell stock, you do it through some kind of a brokerage. Now let's talk about the features of stock itself. When a company is a corporation and does have stock, they have a certain amount of authorized stock, which is the number of shares that their charter allows them to sell. Now, the number of authorized shares, it usually is higher than the number of shares that you actually issue and then are outstanding. So you might be authorized to sell 100,000 shares of stock, but you might choose to only sell half of that, only sell 50,000. So the outstanding stock refers to those shares that have actually been sold to stockholders. When you authorize stock, there's no journal entry at that time that's made. It's not until you actually sell the stock that you have to make some type of journal entry. So you authorize how many shares you're allowed to have, then you issue the number of shares that you need at that particular point in time to be able to bring in the amount of money that you need. Now, you may issue stock at a particular price, but what it sells for in the market could be very different, usually is different. It may be higher or lower than the amount that you issued it at. That's considered the market value per share. Par value stock is stock that has been assigned a par value or a face value. It's usually assigned by the corporation in its charter. Now, it could be a very small amount, and this paragraph explains to you the concept of minimum legal capital, and I'm going to let you read that for yourselves, but right now I just want you to understand that the par value that's been assigned to the stock is probably not going to be the same thing as the market value. These two things are usually different, and that causes us to make different journal entries when the time comes to do that. Now, there's classes of stock, usually two different classes of stock. One is preferred stock and one is common stock. And in the rest of the chapter, we're going to talk about those two different classes and why they're different and how you handle them differently in terms of accounting. So I won't spend too much time on that here. There's also something called no par value stock, or simply no par stock. And it's a stock that has not been assigned a value by the corporate charter. And we're going to talk about that a little bit later too. And then stated value stock starts out as no par value stock, but later has a stated value assigned to it. And we'll talk about that as well. Now, all of the stuff that we've talked about in terms of stock that's been sold to people and the money that has been brought into the company because of that, that is the equity that there is in the company. And it's just known as stockholders' equity. And stockholders' equity consists really of two things. I should say three things. It consists of the stock itself, which is the paid-in capital of the stock. But then, if more was paid in than what the par value of the stock is, that's called paid-in capital in excess of par. We're going to talk more about that. These two things together equal total paid-in capital. This is the amount of money that was actually paid into the company in exchange for stock. Then you have your retained earnings, which is the net income, or could be net loss, of the company that has not been distributed to them, to the stockholders, as dividends. So it's money, at least on paper, that is sitting in the company that could be used for those types of things. So these two things together, total paid-in capital and retained earnings, equals the amount of your stockholders' equity. And we'll be talking about that here in the next section. All right, so let's move to the next section of Chapter 11 and deal with common stock. Now, this section talks about how do you record issuing par value stock, or issuing stock at a premium, which means that you're selling it for more than the par value, or issuing stock at a discount. The entries are all very similar, but there is a little bit of difference in each one of them. So let's go back to par value stock, obviously the easiest one. In this case, a company is issuing 30,000 shares of stock at $10 per share, which is $300,000. The entry is quite simple. You put down cash as the debit because you're bringing in $300,000 in cash, and then your credit goes to common stock, $10 par value. The $10 par value is basically a description just to give people that look at the financial statements the information as to what the par value is. Then you can add a more detailed description. Issued 30,000 shares of $10 par value common stock at par. Very simple entry. So at the end of the year, this is what the stockholders' equity might look like. They have $300,000 in common stock. And this description shows you a couple things. It was $10 par value. 50,000 shares were authorized, but only 30,000 shares were issued and are outstanding. So that comes to the 300,000. During the course of this year, their net income was 65,000, which is still in retained earnings because they haven't made any dividends. They haven't paid any dividends. So if you add those two things together, you get your total stockholders' equity. Pretty simple explanation there. Now, what if you issue par value stock at a premium? So premium occurs when a corporation sells the stock for more than par. So let's say that this Dillon Snowboards sells some common stock at $12 a share, not $10. The par value is $10, but they sell it at $12. The difference between the $10 and the $12 is put into a different account. It goes into an account called paid in capital in excess of par value. So it's still, in this case, we're still talking about 30,000 shares, but the amount of cash that you would bring in would be $360,000 because it's 30,000 shares times $12 a share. But as far as the common stock account, that is still $300,000 because it's 30,000 shares at the par value of $10 per share. The difference between these two numbers, this $60,000, goes into the account called paid in capital in excess of par value. And then you have your same explanation, but in this case it explains that you sold the $10 par value stock at $12 per share. Then your stockholders' equity at the end of the year would look like this. You would have two different accounts, the $300,000 for common stock, the $60,000 for paid in capital, and then you still have your $65,000 in net income, which goes into retained earnings. But in this case, the total stockholders' equity is $425 because of the paid in capital. You would be doing the same type of entry if you sold the stock at a discount. So when you sell your stock at less than par value, you would have to make similar types of entries. However, keep in mind that most states prohibit the selling of stock at a discount. And this explains the reasons why. If, however, it is issued at a discount, the amount that is less than par would be debited to an account called discount on common stock. So it would be listed here, but it would be subtracted from the common stock amount. Now, what if you issue stock that does not have a par value, so you don't have anything to compare it to? The amount the corporation receives becomes the legal capital, and you put it into the account called common stock. So if this company sells 1,000 shares of no par stock for $40 per share, then you would put $40,000, debit cash for $40,000, and credit common stock for the whole amount. But you would list here no par value because there's not a face value on the stock. You just determined that you would sell it for $40 per share. Now, what if you have no par value stock, but it is assigned a stated value? Then the stated value becomes the legal capital. Not what you sell it for, but its stated value. So, assuming that stated value stock is issued in an amount in excess of stated value, the excess is credited to paid in capital in excess of stated value, not par value, but stated value. So, example, corporation issues 1,000 shares of no par common stock, but with a stated value of $40 per share. But they sell it for $50 a share. So 1,000 times 50 means they're going to bring in $50,000 in cash. But because the stated value is only $40 per share, you only credit $40,000 to common stock. The difference between these two, so as to balance your equation, goes into paid in capital in excess of stated value, $10,000. It's also possible to issue somebody stock and not receive cash, but receive some other asset instead. In that case, you have to debit the asset for the market value of what you're receiving. So in this case, they receive land valued at $105,000, so land is debited for $105,000, and they're giving, in exchange for that land, they're giving 4,000 shares of stock that have a par value of $20. So 4,000 times 20 is $80,000. So you would credit the common stock account for $80,000. But because you received $105,000, the difference between these two is $25,000. You have to put that into the paid in capital account in excess of par value. There's another example here of giving stock to somebody who helps you when you're first getting organized. And in that case, the debit doesn't go to land or something like that. It goes to an expense account called organization expenses. I'll let you read that more carefully on your own. But these are the basic entries for issuing common stock and how you would do the accounting entries for that. Now let's talk about dividends. There's two different types of dividends. There's a cash dividend or a stock dividend. Obviously, cash means you're going to get paid cash. Stock means you get more shares of stock as your dividend as opposed to getting paid cash. Three very important dates involved in dividends. The first is the date that the directors declare the dividend. Because on the date that they declare a dividend, they incur the liability to pay it. So that's an important date. That's when the liability is first incurred. Now, who gets the dividend? The dividend is going to go to every stockholder on a particular day. And that day is the date of record. It's a future date specified by the directors for identifying the stockholders that are going to receive a dividend. So they declare a dividend first, and then they say, as of June 1st, every stockholder will receive this amount of a dividend. So if you're a stockholder on June 1st, you are going to get the dividend. And then the third date is the date that they actually pay it. They declare it, they determine who's actually a stockholder on that particular date, and then there's a date that the money is actually paid. So how do we account for that? First of all, this company declares a dividend. They declare a dividend of $1 per share, and there happens to be 5,000 outstanding shares of stock in this company. So on the date of declaration, you have to create your liability, your payable. The debit goes to retained earnings because you pay dividends out of retained earnings, and the credit goes to an account called Common Dividend Payable for the $5,000. On the date of record, there's no entry that's needed. This is just when you're determining who's going to get the dividend. But then on the date that you pay it, in this case February 1st, you debit the liability account because now you're paying it, so you're wiping the liability off, and you're crediting cash because the money's coming out of your account. So that's the pretty simple entries for how to pay a cash dividend. Now, what if your company has a negative balance in retained earnings? Most of the time, a state will excuse me, prohibit a corporation with a deficit from paying a cash dividend. You don't have the money. If your retained earnings is negative, then you don't really have the money to be able to do that. Sometimes some states will allow you to do it, but it's an exception, and these two paragraphs here kind of explain how you go about doing that. Now, let's talk about a stock dividend. A stock dividend is when you give more shares of stock to your current stockholders instead of paying them in cash. stock dividends do not reduce your assets because you're not actually taking cash or any of your assets to pay those things. It's just transferring a portion of equity from retained earnings to contributed capital. So remember, when we looked at our stockholders' equity section, stockholders' equity is made up of paid-in capital and retained earnings. So all we're doing is shifting from one of those accounts to the other. And there's reasons why corporations choose to do stock dividends instead of cash dividends. One of the main ones is to try to keep the market price of the stock affordable. When you do a stock dividend, you create more shares of stock in your company. And by doing that, it brings down the individual value of each share. And that makes it less expensive on the exchange for people to buy your stock. So that's one of the main reasons why we do it. Now, when you're accounting for a stock dividend, you have to distinguish between a small stock dividend and a large stock dividend. A small stock dividend is when you distribute 25% or less of the previously outstanding shares. And a large stock dividend is when you distribute more than 25%. And you record those two things differently. So that's the first thing you have to determine when you're doing a stock dividend, so you know how to record it. So let's look at this particular company, and this is what their stockholders' equity looks like before they do the stock dividend. So you see the common stock, you see $8,000 in additional paid-in capital, and retained earnings of $35,000. Well, what happens if they do a small stock dividend of only 10% of the shares? They have 10,000 shares, so 10% would be 1,000. So they're going to issue another 1,000 shares to their current stockholders. So that's a small stock dividend because it's less than 10%. And the way we record that is we debit retained earnings because we're going to move the capital from retained earnings into stock. And the par value of the stock is $10 a share. So 1,000 shares times $10 a share is $10,000. But the value, the market price of the shares on the day that they do it is $15. So the difference has to go into the paid-in capital account. So we debit retained earnings for $15,000 and we credit the common stock for the par value, and then we credit the paid-in capital for the part that's in excess of par value. Now, on the date of declaration, it actually goes into an account called common stock dividend distributable because you haven't distributed it yet. So this is kind of like a payable account, but it's for stock as opposed to cash. So after you declare the dividend, this is what the stockholders' equity would look like. You still have $100,000 here, but now you have $10,000 in the common stock dividend distributable. You have $13,000 in paid-in capital because you have the $5,000 here plus the $8,000 that was already in there before. But because you just debited retained earnings for $15,000, your retained earnings is now only $20,000. Total stockholders' equity remains the same. It's still $143. It's just been redistributed, taken out of retained earnings and put into creating more common stock. Now, when you actually pay the dividend on the date of payment, your debit goes to the distributable account, so you're taking that back out, and then it goes directly into common stock. So what you would end up having after you actually pay it is this line would disappear, and you'd have $110,000 in common stock. Now, what if this was a large stock dividend instead of a small stock dividend? Let's say they were going to do 30% instead of 10%. You handle it a little bit differently then. Then you debit retained earnings for only the par value, and you credit common stock for the par value. So it's 3,000 shares times $10 is $30,000. And then on the date you would actually pay it, you would debit common stock dividend distributable, and then you would credit the common stock account for $30,000. So it's similar to what you do for a small stock dividend, except there's no effect on paid-in capital in excess of par. One other way that you can get a stock dividend is a stock split. And this is where the company will generally decide a ratio. They'll say we're going to do a 2-for-1 split or a 3-for-1 split. And then on a given date, for every share, let's say it's a 2-for-1 split, for every share that you have, you're now going to have 2 shares. And what that does is, like in this example, this company has outstanding shares of $20 par value stock, but the current market value is $88. A 2-for-1 stock split will cut the par value in half. So their par value now becomes $10 a share, but it also will basically cut the market value in half. So instead of having 1 share worth $88, you would have 2 shares, each worth $44. One of the main reasons why we do a stock split is that the price of the stock has gotten too high for your average investor to want to purchase it. By doing a stock split, they can better afford to buy stock at $44 a share, and obviously the hope is that this will begin to climb again immediately and start rising even faster than it would if it had started at the 88. And the paragraph here explains a little bit about the differences and how you might record that. But this is how dividends is handled from an accounting standpoint. Both the cash dividends that we talked about first and then a stock dividend that we just spoke of. All right, let's talk about preferred stock. What we've been speaking of so far is pretty much all common stock. But some companies, and it's definitely not the majority, 73% of our corporations in America only issue common stock. Only 27% issue preferred stock. Preferred stock gives some special rights to the stockholders. And one of the main things it does is it gives them preference over receiving dividends. If a company issues a dividend, then the money first goes to the preferred stockholders, and then if there's anything left, it goes to the common stockholders. But preferred stockholders, one of the things they don't get to do is vote. And this is one of the reasons why corporations will issue preferred stock, is because they need the money, but they don't want to lose control of their company. So they can issue preferred stock, which brings money into the company, but those preferred stockholders do not have voting rights. Anyway, how do you handle the issuance of preferred stock? It's basically the same thing as what we had done before. Usually it has a par value, but it can also be sold at a premium or a discount. If Dillon Snowboards issues 50 shares of $100 par value stock for $6,000 cash, this would be your entry. Cash is $6,000. The stock is $5,000 because it's 50 shares times the par value. And then you'd have $1,000 for paid-in capital in excess of par value. So this is how your stockholders' equity section would look. Now, the way that the dividend preference works for preferred stock, again, if there's only a certain amount of money declared as a dividend, preferred stockholders get their part first, and then if there's anything left, it gets distributed to the common stockholders. There's also a difference between cumulative and non-cumulative dividend. Cumulative preferred stock is when the preferred stockholder has a right to not only the current dividend from this year, but any prior dividends that were not paid because the company didn't have the money. Now, if a preferred stockholder, if the directors do owe the money to the preferred stockholders. It's referred to as dividend in arrears. And the accumulation of those dividends in arrears, it could add up to quite a bit of money, but it still doesn't guarantee that somebody's going to get it, because you have to declare a dividend before the preferred stockholders actually have any rights to that money. Then there's non-cumulative, which means if there's a dividend that's declared, you get it in the current year, but you're not necessarily entitled, or you're not entitled to any of the dividends from prior years. So they give you an example here. The difference between cumulative and non-cumulative preferred stock. Let's look at the assumption here. A corporation's outstanding stock includes 1,000 shares of $100 par, 9% preferred stock. The 9% tells you how much the dividend would be. So it would be 9% times the 1,000 shares, which would be $9,000 per year in potential dividends. They also have 4,000 shares of $50 par value common stock. Now, if in the first year the directors declare cash dividends of $5,000, then in the first year, in both cases, the $5,000 is going to go to the preferred stockholders, because they should get $9,000, but there's not that much of a dividend declared. So all $5,000 that they do declare goes to preferred stockholders, here and here. And the common stockholders would not get anything in that first year. So let's move to the second year. In 2013, they declare cash dividends of $42,000. So $42,000, if it is non-cumulative, the preferred stockholders get their $9,000 for this year, but they don't get anything for the fact that they were shorted the year before. So after the $9,000 is paid to the preferred stockholders out of the $42,000, you have left $33,000. But if it is cumulative, the preferred shareholders do not only get the $9,000 for this year, they get the $4,000 that they didn't get last year. So $13,000 is paid to the preferred shareholders first, and then whatever's left, so you take 42 minus 13, $29,000 would be distributed to the common stockholders. So that's the difference between preferred stock that is non-cumulative and preferred stock that is cumulative. This part here I'm going to let you read for yourself, as well as the reasons as to why a corporation may choose to issue preferred stock instead of just common stock. So I'll let you guys read that on your own. Let's briefly talk about treasury stock. Treasury stock can be confusing, but the entries for it are actually relatively simple. Treasury stock is basically when a company reacquires shares of their own stock. So this is stock that they have sold, and now they're buying it back. And there's reasons to do that as well, or we won't really get into that, but let's just talk about some of the characteristics of treasury stock and how we account for it. Treasury stock is not considered an asset. It is not entitled to cash dividends or stock dividends, and it does not exercise any voting rights. So when the corporation buys back that stock, it doesn't give them votes toward anything within the company. So let's look at some of the entries. If a company purchases treasury stock, what they're doing is they end up reducing the corporation's assets and equity by equal amounts. Now we're going to talk about the cost method. There's a par value method, but that's for more advanced courses. So let's look at what happens here. Say this is a corporation's basic balance sheet. Cash $30,000, other assets $95,000, so their total assets are $125,000. They have $100,000 in common stock, and they have $25,000 in retained earnings. Very basic. But what happens if they purchase 1,000 of their own shares? This is what it would look like. You debit treasury stock common for $11,500 because treasury stock is a contra equity account. It's going to reduce the amount of your common stock. So common stock is normally credited, so treasury stock would be debited. And then what is credited is cash because you're paying cash for it. This is what the balance sheet would look like after doing that. So you take the $11,500 out of cash, so now you only have $18,500. Your other assets are still $95,000, so now your total assets are $113,500. Common stock is still $100,000, retained earnings is still $25,000, but now you have a contra equity account, treasury stock, which is a negative $11,500, so that ends up being $113,500. So your balance sheet equals. Now, the other thing you have to notice here is that you still have 10,000 shares of stock, but 1,000 of those shares are in treasury, which means you only have 9,000 shares outstanding. Now, what if you then reissue that treasury stock? So you sell some of the stock that you purchased that's in treasury. This gives an example of Cyber reissuing 100 of the 1,000 shares that they have in treasury at $11.50 per share, which is the same thing that they had paid for it. So if that's the case, they would debit cash for the amount that they bring in and credit treasury stock for that same amount because they're selling it at what they paid for it. They're selling it at cost. But what happens if they sell that treasury stock above cost? So the next example says that they sell 400 treasury shares that they originally paid $11.50 for, but now they're going to sell it for $12 a share. So the amount of cash that comes in is $4,800, but the amount that is credited to treasury stock is the amount that they originally paid for it, which is the $11.50 times 400 shares, which would be $4,600. So the difference of $200 has to go into an account called paid in capital treasury stock because they made $200 on this, so they have $200 additional paid in capital. But what if you sell the treasury stock below cost? You can probably imagine what the entries would be like. In this case, the remaining 500 shares of treasury stock are sold at $10 per share. Now remember, they originally paid $11.50 for it. So cash is pretty easy, $5,000. But there's a loss of $750. Now you have $200 in paid in capital that you can clear away, so to speak. But then where does the other $550 loss go? And this is where it comes directly out of retained earnings. The $550 additional, you had made $200 and now you've lost $750. So you wipe out the $200 that you originally made, but you also have to account for the $550, and that comes directly out of retained earnings. So if you sell it at a loss, depending on how much paid in capital you have, you first take it out of paid in capital treasury stock, and then if that's not enough, then you take it directly out of retained earnings. And then your credit goes to treasury stock common, and this would reduce the treasury stock account to nothing. And then this paragraph explains that you also can actually purchase its own stock and retire it to where it's no longer even on the books, and this explains what you do in that situation. So the entries for treasury stock are really not very complicated. It's just usually not something that most students have had any experience with. Now, we've been talking throughout this chapter about the statement of retained earnings that takes place at the end of an accounting period, and this is basically what a statement of retained earnings would look like. You start with your beginning balance from the previous year. You may have some prior period adjustments, which is what is explained up here. These have to do with errors and things like that. You may also have some changes in accounting estimates that cause changes in this. But we take the beginning balance, any prior period adjustments, and then come up with a subtotal. Then you add your net income for the year and subtract any dividends that have been declared. And that's how you get your final figure for retained earnings. So generally at the end of every financial period, you're going to have a statement of retained earnings, and this is the process that you would go through. Remember, in order to get those figures for retained earnings, we've already closed all of these balances. We closed credit balances and revenue to income summary, debit balance from the expense accounts goes to income summary, then you close income summary to retained earnings, and that's how you get your net income or net loss here. And then in addition to that, depending on how you handle dividends, some people have dividends in a separate dividends account, and if that's the case, you would have to close dividends to retained earnings, and that would give you your final figure here. Some people do it a little differently by having a statement of stockholders' equity. You can read this and look at the example that they have. And then this also talks about how you go about reporting stock options on your balance or on your financial statements. One last thing I want to mention is a couple of these ratios at the end of the chapter. Please take some time to look at this because you're going to have to do this in your homework. But earnings per share, this is the example of the equation of how to go about doing this. To figure out what the EPS or the earnings per share is for a company, you take the net income for that year, subtract any preferred dividends, and divide it by the weighted average common shares outstanding. So basically the number of common shares outstanding will give you your earnings per share. So they give you an example from this particular company, Quantum. So they have $40,000 in net income, they have $7,500 in preferred dividends, and they divide that by the 5,000 shares of common stock, which gives us a $6.50 per share dividend, or earnings, I should say, for common stock. And then you have to determine as an investor, is this what you're looking for? If you have 1,000 shares in this company, what is this going to return to you each year in terms of a dividend? Another important ratio is the price-earnings ratio, which is calculated by taking the market value per share and divide it by the earnings per share. So you have to know what the market value price per share is, and you have to have done this up here to be able to come up with this price-earnings ratio. Price-earnings ratios are used extensively in the financial world to determine if a company is doing well or not doing well. Well, that's not exactly right. It helps you determine if their stock is overpriced or underpriced, and it would be a good buy for you. So the average price-earnings ratio of stocks in the last 62 years, it has worked out to 14. So when you do this calculation, the number 14 is the average of stocks in this very lengthy period of time. So today, analysts will say that stocks with high price-earnings ratio, something like higher than 20, are probably overpriced. And those with low price-earning ratios, less than 5 to 8, are more likely to be underpriced. So they would be saying basically that they're probably a better deal. So after you do this ratio, you would compare it to something like this and decide whether or not you would want to invest. Now, obviously, it's rarely so simple as for us to rely on a single ratio. You want to look into some other things as well, but this is one of the key things that investors do look at to determine if they want to buy that stock. And then there's a couple other ratios here. Dividend yield, it shows you how to calculate that. And then book value per share. So I'll let you read those on your own. But take note of these ratios are at the end of the chapter because they really are important and used extensively in the financial world for making good investment decisions.